Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, let me introduce myself. My name is Eka Susanti with NPM 2241106 from Management Class 22. Here I will explain the material regarding the tax collection system, types of taxes, tax rates, tax functions. 1. The tax collection system. The tax collection system is a method designed by the government to ensure the effective and efficient collection of taxes. Its goal is to secure state revenue, which is used for development and public services, such as healthcare, education, and infrastructure. According to Sumarson 2022, there are several primary tax collection systems. A self-assessment system. This system is the most commonly used, particularly for income tax PPH and value-added tax PPN. Here, taxpayers have full authority to calculate, pay, and report their owed taxes to the tax authority. The official assessment system. In the official assessment system, the tax authority determines the amount of tax that taxpayers need to pay, usually applied when there is a potential for data manipulation by taxpayers. C. Withholding system. In the withholding system, taxes are directly deducted from income sources by a third party, such as a company or employer. A key example of this system is Article 21, income tax applied to employee salaries. D. Administrative principles in tax collection. Tax collection systems should be based on solid administrative principles to create legal certainty, fairness, and efficiency. Sumarson 2022 explains key principles in the tax collection system. 1. Justice principle. The tax system should reflect fairness, imposing taxes based on the ability to pay. Higher income or wealth should correlate with higher tax contributions. 2. Simplicity principle. The taxation process should be simple for taxpayers to understand. A complicated system may discourage or make it difficult for taxpayers to fulfill their obligations. 3. Use of administration principle. The tax system should make it easy for taxpayers to carry out their tax obligations, including calculation, reporting, and payment. 4. Efficiency principle. The tax collection system should be designed to minimize government administration costs in collection, management, and supervision of taxes. 5. Transparency principle. The government should be transparent in tax fund usage, allowing the public to understand the benefits of the taxes they pay. 2. Types of taxes. Types of taxes in Indonesia can be classified based on various aspects, such as nature, objects, and the level of government that collects them. The main classifications according to Sumarson 2022 are taxes based on nature. 1. Direct taxes, paid directly by the taxpayer and cannot be transferred to others. For example, income tax PPH is directly imposed on individuals or businesses based on earned income. Examples: income tax PPH, land and building tax PBB. 2. Indirect taxes. The tax burden can be transferred to others. For instance, value-added tax PPN is ultimately paid by the end consumer in the consumption process. Examples: value-added tax PPN, import duty. B. Taxes based on collecting authority. 1. Central taxes managed by the central government and used for national expenses. Some central taxes include income tax PPH, applied to income earned by taxpayers, both individuals and entities. Value-added tax PPN, imposed on the added value of goods or services consumed in Indonesia. Luxury goods sales tax PPNBM, applied to luxury goods to control consumption and increase state revenue. 2. Local taxes managed by regional governments at the provincial or district, city level, used for regional interests. Examples include motor vehicle tax PKB, applied to registered motor vehicle owners in a specific region. Hotel and restaurant tax, applied to hospitality and restaurant service providers within a certain area. C. Taxes based on objects. 1. Income tax PPH. Applied to any income received by individuals or businesses, whether from domestic or foreign sources. Income includes salaries, business profits, and capital gains. 2. Value-added tax PPN. Imposed on every transaction of goods or services in Indonesia, usually paid by end consumers. 3. Land and building tax PBB. Applied to ownership or use of land and buildings, generally managed by local governments to strengthen regional revenue. 4. Stamp duty. Charged on certain documents that have economic value or legal evidence, such as contracts, deeds, and other documents. 5. Customs duty. Imposed on imported or exported goods to or from Indonesia, including import duty on imports and excise on specific goods considered impactful to society, like cigarettes and alcoholic beverages. D. Taxes based on rates. 1. Fixed rate. The tax amount remains fixed regardless of the taxable base or the number of taxable objects, such as stamp duty. 2. Proportional rate. The rate percentage remains fixed, but the tax amount varies based on the taxable base. PPN generally applies a proportional rate. 3. Progressive rate. The rate increases with the taxable base. For example, income tax PPH applies a progressive rate. The higher the income, the higher the applicable tax rate. 3. Tax rates. A definition of tax rate. The tax rate is the percentage used to calculate the amount of tax payable by taxpayers based on their taxable objects, such as income, profit, or specific goods value. According to Sumarson 2022, tax rates can be classified into various categories based on characteristics, purpose, and economic impact. B. Types of tax rates. 1. Flat rate. Applies the same percentage to all taxable objects regardless of income or profit. Sumarson notes that a flat rate is typically applied to certain taxes, such as vehicle tax or property tax PBB. 2. Progressive rate. Increases with the taxable base. Used primarily for income tax to ensure ability to pay fairness. 3. Degressive rate. Decreases as the taxable base increases, though this is rare and may be applied to attract investors or encourage spending in specific sectors. 4. Proportional rate. Maintains a fixed percentage regardless of the taxable base, commonly used in consumption taxes like value-added tax PPN. Tax functions. Definition of tax functions. Taxes serve not only as a state revenue source but also have social, economic, and regulatory roles. In tax law, Sumarson describes tax functions as essential instruments for supporting development, maintaining economic stability, and achieving social welfare. Main functions of tax. 1. Budgetary function. Taxes are the primary source of state revenue used to fund public expenditures, such as infrastructure, education, health, and security. 2. Regulatory function. In addition to generating revenue, taxes act as tools to regulate or control various economic and social aspects. By adjusting tax rates, the government can influence consumption, investment, and production patterns. For example, high taxes on luxury goods control consumption and increase state revenue. 3. Income redistribution function. Redistributive function. The income redistribution function aims to reduce social and economic welfare. By implementing progressive taxes on high-income groups, the government can collect more income from wealthier groups and allocate these funds to social programs. Sumarson noted that this function is important in realizing social justice. That's all my explanation. Thank you and wassalamualaikum warahmatullahi wabarakatuh.